On Tuesday, July 8th, Bank of America made an announcement that caught the attention of investors everywhere. The bank's metals research team, one of the most closely watched groups on Wall Street, released a new forecast for gold. And it was not the number people expected. Bank of America cut its 2026 average gold price forecast by 14%. The new number dropped from $5,093 an ounce down to $4,206 an ounce. For many investors watching gold closely, this felt like a shock. Headlines spread quickly across financial media. Words like bearish and downgrade were everywhere within hours. But why did this happen? The bank gave a clear reason. They pointed to the Federal Reserve. Analysts said the Fed was becoming more hawkish, meaning it may be more willing to raise interest rates instead of lowering them. This matters a lot for gold. Gold does not pay interest like a savings account or a bond, so when interest rates go up, other investments start looking more attractive. Investors sometimes move away from gold when this happens. That shift can push prices down. Bank of America's team explained the details behind their thinking. They said conflict in the Middle East, especially near the Strait of Hormuz, was keeping energy prices high. Higher energy prices tend to lead to higher inflation. And when inflation stays high, the Federal Reserve often responds by keeping interest rates elevated or even raising them further. This chain of events was the foundation for the bank's new forecast. At the same time, something important was happening in the markets. Just one day before the Fed's plans were announced, gold experienced a rough stretch. Former U.S. President Trump had declared a ceasefire between the U.S. and Iran at a NATO summit in Ankara, Turkey. Oil prices reacted immediately, surging more than 5% before pulling back slightly. This kind of sudden movement often creates ripple effects across other markets, including gold. Despite the dramatic headline number, gold was still trading above $4,100 an ounce. That price was actually higher than where it had closed just 2 days earlier. In other words, gold was not collapsing. It had already absorbed much of the recent volatility before Bank of America's report was even released. Many news outlets focused only on the 14% cut. They reported the number and moved on, framing it as simply bad news for gold. But that single number does not tell the whole story. Bank of America's report contained more detail that many people missed entirely, and that detail changes the picture significantly. Viewers watching Crest Finance will hear the full context in the parts ahead. It's also worth noting that Bank of America was not alone in adjusting its outlook. JP Morgan, another major financial institution, also flagged near-term downside risk in their own gold forecast that same week. Yet both banks kept a longer-term bullish view stretching into 2027. This shows a pattern. It is not that major banks believe gold is finished. Instead, they are adjusting the timeline for when they expect prices to rise. This distinction matters greatly for anyone following the gold market. A short-term caution is very different from a long-term shift in belief. Investors who only see the headline may draw the wrong conclusion entirely. To understand where gold may be headed next, it helps to look closely at the rules and numbers behind the Federal Reserve's decisions. These details were buried deep inside Bank of America's report, and most news outlets skipped right past them. The Federal Reserve met in June and made a choice. It decided to hold interest rates steady, keeping them in a range between 3.5% and 3.75%. On the surface, that sounds calm and stable. But the meeting minutes, released just days later, revealed something far more interesting. Out of 18 committee members who helped guide Fed policy, 9 of them projected at least one more rate hike before the end of 2026. That is exactly half the group leaning toward higher rates. Markets took notice. Based on data from the CME FedWatch tool, investors were pricing in roughly a 70% probability of at least one more rate increase before the December meeting. This is the exact mechanism Bank of America based its forecast on. Here's how it works, step by step. When investors expect higher interest rates, the US dollar tends to grow stronger. A stronger dollar makes gold more expensive for buyers using other currencies. That reduced demand puts downward pressure on the price. It is a simple chain, and for the short term, Bank of America's reading of it appears accurate. However, there is a much bigger number sitting quietly behind all of this, and it changes everything. The United States national debt has now crossed $39.4 trillion, according to official Treasury data released as of July 6th. That number alone is difficult to picture, but here is what makes it truly significant. Annual interest payments on that debt have already surpassed $1 trillion in the current fiscal year, based on figures from the Congressional Budget Office. To put that in perspective, the interest payments alone are now larger than the entire United States defense budget. This creates a serious limit on what the Federal Reserve can actually do. If the Fed raises interest rates aggressively, it does not just slow down the economy. It also makes the government's own debt more expensive to manage. Every rate hike adds pressure to an already massive interest bill. This is the part of the story that rarely makes headlines, yet it may be the most important detail of all. A Federal Reserve that talks tough on inflation may simply not have the room to follow through with aggressive action for very long. Now here's the detail buried inside Bank of America's own report that most coverage never mentioned. While the bank cut its 2026 average forecast, it also stated that gold could still reach $6,000 an ounce once the Federal Reserve's tightening cycle comes to an end. That number is nearly 1.5 times higher than gold's current price. It did not appear in most headlines, yet it was written directly inside the same report that caused the bearish news cycle. Central banks around the world appear to be paying close attention to this bigger picture. According to the World Gold Council's most recent central bank gold reserve survey, a record 89% of central banks expect global gold reserves to increase over the next 12 months. Even more notably, 45% of those banks said they personally plan to increase their own gold holdings. These are not short-term traders reacting to daily headlines. These are institutions planning years, even decades ahead. So while short-term signals point toward caution, the deeper rules and numbers tell a very different story. The Federal Reserve's own limitations, combined with steady central bank buying, suggest this may not be the moment to walk away from gold entirely. Every financial decision creates ripple effects, and Bank of America's gold forecast is no exception. To understand what this really means, it helps to look at the consequences from several different angles. The economy, everyday investors, global central banks, and even ordinary households trying to protect their savings. Let's start with the broader economy. When a major bank cuts its price forecast, it can shift investor sentiment almost overnight. Traders who watch these reports closely sometimes adjust their positions quickly, selling gold in the short term to avoid potential losses. This can create temporary price swings that feel dramatic in the moment, but do not necessarily reflect the long-term direction of the market. Economists often describe this as noise rather than signal. It grabs attention, but it does not always predict what comes next. For everyday investors, the consequences are more personal. Many people hold gold not to make a quick profit, but to protect their savings from inflation over time. When headlines describe a forecast as bearish, it can create fear. Some investors may feel pressure to sell, worried they are making the wrong decision by holding on. Financial experts frequently caution against this kind of reaction. Short-term forecasts and long-term financial goals are often two very different things, and confusing the two can lead to costly mistakes. Now, consider the perspective of central banks around the world. Their goals look nothing like those of a short-term trader. A central bank reserve manager is not trying to guess where gold will trade next month. Instead, they are focused on protecting their nation's purchasing power over 10, 20, even 30 years. This is why China's central bank added nearly 15 tons of gold in June alone, marking its largest single-month purchase since October 2023. This extended the bank's buying streak to 20 consecutive months in a row, bringing its total holdings to roughly 2,146 tons. What makes this timing especially important is when the buying happened. June was also the month gold briefly dropped below $4,000 an ounce, marking its worst quarterly decline in 13 years. While many short-term traders were pulling back, China's central bank was doing the opposite. It was buying during the weakness, a strategy often described simply as buying the dip. This kind of behavior tells a very different story than the one found in daily headlines. There are also broader implications tied to global trade and financial infrastructure. A new gold trading hub is being developed in Hong Kong, connected directly to the Shanghai Gold Exchange. Analysts view this development as a sign that gold's role in the global financial system may continue to grow, not shrink, especially as more countries look for ways to diversify away from traditional currency reserves. Of course, it is only fair to present the other side as well. Short-term caution from banks like Bank of America and JP Morgan is not without merit. Inflation data remains a real concern, and if inflation stays elevated, the Federal Reserve may feel forced to keep interest rates higher for longer, regardless of the pressure that puts on national debt. In that scenario, gold could face continued headwinds well into next year. Balanced analysis requires acknowledging both possibilities rather than assuming one outcome is guaranteed. For communities and households, these dynamics matter more than they might first appear. Many families view gold as a form of financial insurance, something to hold on to during uncertain times. When institutions send mixed signals, it can create confusion for people simply trying to make responsible decisions with their savings. This is exactly why understanding the full picture, not just the headline, becomes so important. After looking at the facts, the rules, and the consequences, one question remains for every viewer watching this story unfold. What happens next, and how should people prepare? The next major data point to watch arrives soon. On Monday, July 14th, the June Consumer Price Index, commonly known as CPI, will be released at 8:30 a.m. This number measures inflation, and it plays a direct role in what the Federal Reserve decides to do next. For context, May's inflation reading came in at 4.2%, marking a 3-year high. If the new reading comes in below 3.8%, it could ease pressure on the Fed to raise rates further, which may remove some of the short-term headwind facing gold. However, if the number comes in at or above 4.2% again, that pressure is likely to continue, keeping the cautious forecast in play for a while longer. This single data release matters more than most people realize. It is not just a number for economists to analyze. It directly affects mortgage rates, savings account returns, borrowing costs, and yes, the price of gold. Viewers who want to stay ahead of these shifts should keep an eye on this date and pay attention to how markets react in the days that follow. Beyond this immediate date, there are longer-term signals worth watching as well. The World Gold Council's mid-year outlook currently places $4,000 as a fair value floor for gold, supported by steady central bank demand. At the same time, central banks around the world continue signaling long-term confidence in gold, with a majority expecting global reserves to grow over the next year. These are not short-term bets. They are long-term positions built on decades of experience managing risk. For everyday viewers, the key takeaway is simple. Short-term forecasts and long-term strategies often tell two different stories. A bank lowering its one-year price target does not necessarily mean it has lost confidence in gold's future. In this case, the same report that caused bearish headlines also pointed toward $6,000 an ounce once the Federal Reserve's tightening cycle ends. That detail alone should encourage viewers to look deeper before reacting to any single headline. So here are a few honest questions worth sitting with. Does a short-term dip in forecasts change the reasons someone originally chose to hold gold? Are today's headlines reflecting the full picture or just the easiest part to summarize? And when central banks around the world are buying during weakness, what does that suggest about how professionals view risk compared to how everyday investors often react to fear? These are not questions with easy answers, and they are not meant to push anyone toward a specific decision. Financial choices are personal, and they depend on individual goals, timelines, and comfort with risk. What matters most is having complete information before making any decision, rather than reacting to a single number or a dramatic headline. Viewers who want to stay informed going forward should watch for three things in the weeks ahead. First, the CPI report on July 14th and how markets respond to it. Second, any further comments from Federal Reserve officials about future rate decisions. Third, continued reports on central bank gold purchases, especially from major economies like China, as these often reveal long-term thinking that short-term headlines tend to overlook. This story is far from finished. Markets will continue to shift, forecasts will continue to change, and new data will continue to arrive. What stays consistent is the importance of looking past the headline and understanding the full context behind every major financial story. Thank you for spending this time with Crest Finance. Stories like this one show why patience and full understanding matter more than quick reactions. Stay informed, stay balanced, and continue following along as this story, and many others like it, continue to develop.